Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Thursday, September 4th, 2025. It is 12:59 p.m. Eastern Time, so we've got about 3 hours left in the trading day. And here's what I want to do, just kind of go over some of the things I'm watching, a couple updates I made to the site, some replies to chart requests that I've made. Others might find those useful. And again, just kind of highlight some of the things I'm watching right now and where the trading ops might be. All right, so this is QQQ. Remember the other day I laid out a zone for you. Let me change my tool here. Color that up blue. No, let's make that. Let's make it this color here, cyan. All right, so that's the short reentry zone off T1 that I gave you. And we're a hair above it now. And what that, the reason it's a zone, it's objective to short to the bottom, up to the top. The top was that gap, and not really above that. Now you can certainly. I mean, remember when you short a stock, it's like going long in reverse. When you buy a stock long, the cheaper you buy it, assuming it goes to where you think it's going, the better the price, right? Same thing in reverse on a short. However, again, it shows strength that we're above that gap right now. It's not much. If you zoom in, so in other words, you get back down in there, then it means it failed to break out above there because it was a gap backfill. There's the big old gap. We're above it now. We had one failed attempt there. And if this fails, then yeah, I do think it's subjective to add in there and just maybe sit tight now on what you have. Again, it's not an all-in moment. This is where, in my opinion, it makes sense to start getting aggressively short for a long, multi-week, multi-month swing trade, or even a multi-month trend trade if and when T2 is taken out. So we still have some economic reports. I'm going to loop back to QQQ in a sec, and towards the end of the video, if there's time, I'll go over the top components of the S&P 500 and Nasdaq 100, the big tech stocks. But let me show you a couple things I've done here in the site. I updated the economic calendar, the link to the economic calendar. When you click on resources up here on the top menu of the site, and you get into down here, tools of the trade. I've forever and a day been using the Econoday economic calendar, and then it's going through the video, at least on the site. And then going through the video the other day, I realized that on my phone I use, and I'm a very avid fan. I love the investing.com app. You have live futures, real time. You don't even have to have a paid subscription. I'll give you real-time quotes on just about all the stock futures and all the futures, agricultural commodities, natural gas, crude, charts, what things are doing pre-market, post-market, individual stocks. So I've replaced the economic calendar. If you prefer the look or feel of that Econoday, it has a pretty fluid feel to it. And again, so it's right there. You can click this link and that'll open up the Econoday economic calendar. What I like about this investing.com calendar, I was showing you the other day in one of the videos, when you click on any one of the reports, so let's just go to, we'll go to today's ISM manufacturing. Well, you can see right here, let me zoom in a little bit. I know this is small in the video, so I'll zoom in here for you. So ISM, for example, this is, nope, that was Tuesday. Today is Thursday, so here we go. You go to ADP, and you can see they gave you, just like the Econoday did, you have the consensus numbers right there, actual, forecast, previous number. But what's nice about it, and of course you have, just like Econoday, they rank them, they use bullheads here instead of stars. Econoday is a we'll flag it, if it's an important one. So I've sorted this. I filtered out everything. If you want the full calendar, you can go down here and click a link, and they'll somewhere there they'll give it to you. There it is, filters. So I have it filtered to only show the U.S. If you are living in another country, Canada, or you're overseas, Europe, anywhere else, you can add your country's economic calendar. You can also add on the filter here what importance level you want. I'm just showing the top two. If you put one star or one bullhead, you get a ton of different things, and it's kind of noise in my opinion. But again, it's all there if you want it. And what I was getting at here, I like this fact that you can click on the report, which I'm doing here. And although it's not showing directly on the site either. It's not showing you the chart when you click there on chart, but you can see the history right there if you want to see the trend, where they've been coming in versus forecast. That's nice. And you can click that link right there. Click here for full events. And Okay, I was going a little slow there. And that's it. So there it is. You can see the chart, and that's nice to see how something's trending. You can change it to whatever format you want there. And again, so you can see, for example, this is ADP, as I mentioned, and I've read about this more and more. Institutions and professional traders are going to start leaning on this a little bit now that we may not be able to trust the government data as much due to the fact, Trump is trying to control that by firing people that, work for government agencies that publish numbers he doesn't want to hear. Again, there it is. And you can see the trend. You can see where things are going. And so that's a nice feature there. Again, going back to the calendar, if you want to view the Econoday calendar, you can do that as well. And you can see there they also have, they'll give you some detail on that. Let's see, did I refresh this? Is that this week? Yeah, there it is. Okay, so you can see and click on ADP and see where it came in, except they don't give you the chart of ADP. They just give you on every indicator, they give you this relative performance thing here. Okay, and just jumping back to the site, I like to go in from time to time, kind of make a mental note. If I'll usually look at the last few updates, last few posts. This one I believe I did cover in yesterday's video, everything on here. Again, there was a chart of the VIX, which I posted. I went over yesterday, and somebody asked for an update on the feeder cattle and UPS, which I did cover in the video for you, and then I replied to there and give you a link to that video. Still very much like that. As far as commodities go, ag commodities, those are probably my two top picks right now: feeder and live cattle futures. And again, there are to the best of my knowledge, there aren't any ETFs or ETNs out there. There used to be, and they got rid of that one. It was, I think, COW was the ticker, and it had both live and feeder cattle, if I'm not mistaken, but they discontinued that. So back to this, just cover just hit on a few of the charts that I provided today, or thoughts. That's just, again, that one was from yesterday. Someone just commented on gold. Yeah, gold broke out. It's broke out of that multi-month trading range. Gold has been surging. Everything's been surging. The only thing not surging is my brokerage account. Got to diversify, and pick trades, go long, short. It's what I like to do, especially in this market. I'm going to get to that towards the end when I get back to the indexes. Show you we're seeing an increasingly drastic differential or performance difference between the equal weighted, especially the equal weighted NASDAQ 100 and the regular. So a couple charts if you're interested. As far as natural gas, again, that's as far as commodities go, my favorite right now. I think it has the best upside potential. Again, I call natural gas a widowmaker. Don't fall in love with it. Use your stops. Your stops are going to be commensurate with your price target or targets and your particular entry point. I can post frequent updates here highlighting objective entries, add-ons, pullbacks on support. You can take profits when targets are hit. So again, everybody is going to have a different cost basis at any point in time, assuming they're in the trade. So I did provide a couple charts here. RRC, you can see there you have a nice clean primary uptrend line. If it gets to that uptrend line and there's some nice price support below it, just hit the price support. So this is the most objective buy zones down here, on the uptrend line, or that almost intersecting horizontal price support. We're at resistance right now. We just took out this minor downtrend line. So if we can pop that, you can see these are the two potential targets. A little bit right there. I could put a sub target or an additional target there. And you'd want to stop below. Remember, we're coming off a really big divergent high, just like this one, But so far that drop was about commensurate with the previous two. Again, took us very close, but not all the way to the trend line. Sometimes that happens. This point here, we didn't really have much of a trend line developed. It started really developing there. It's let's just say a bit atypical not to tag that trend line. So could certainly see that another thrust down. And again, you may or may not get that. You already bounced off support. You came close to the trend line. If natural gas starts to run really hard, then yeah, this one will probably continue up. But so either way, that's your objective entry points. Right now it's at resistance, so if it doesn't pull back and you want objective entry, you're going to want to see it take out this current 84, 83-ish level that it's testing right now. And the other one was AR, and similar, birds of a feather flock together. There you go. There's your uptrend line, nice and clean. Just hit it with really nice price support too. I wish I would have seen this one here. And this is why I do these updates. This is why I encourage, chart requests from you guys. There's thousands and thousands of stocks out there, and I can't possibly track, monitor, cover them all. So I welcome these. Sometimes I don't have an opinion on a chart. I'm going to tell you that. But on these, that was and would be if you get another pullback to it with a stop somewhat below an objective entry. Plus, you had nice positive, aka bullish divergence on this one, just like you had positive, aka bullish divergence here at that low. So there it is. Nice price support. We're at resistance now, 32.26-ish. You have the 200s and the next and first price target up there, 35.22. Most likely a reaction there, and if it can pop that, then yeah, maybe it can run all the way up here. So those are those two. Somebody asked about the copper plays. In this one, I don't have a very good read or a strong opinion on either, but what I said there, they both have triangle patterns. They're a little bit different. They both have trend lines off the highs. This is FCX, big one, Freeport, McMoran, and then an uptrend line there. So we're approaching the apex. You also have some price resistance right above. So yeah, if it can pop that and copper goes up, great. If not, break of that downtrend line is going to be hard to spin as anything but bearish. If it breaks that. The other one was SCCO, Southern Copper. This is a nice symmetrical triangle pattern, meaning it's pretty well defined. Those are indecision patterns. They can break either way, and whichever way they break will most likely determine the next tradable trend. There's my first nice resistance level and a potential price target about 107.80. And so if it takes that out, next one's up there about 119.137 or 119.37, excuse me. And then we have some price support-ish, more of a zone really from about 91 down to about 90 right there. And so that's what that looks like. And yes, we still have copper as a long trade idea. Threw that out to you recently, and it's kind of just spinning its wheels. We hit our first target. It's profitable. No reason to let a profitable trade go to a loser trade. Go to raise stops to break even. Here, I'll get to that. Or assure a profit if that's what you want to do. It needs to go up here. There's T2 and see. So copper also. It came very close. This is a very well-defined downtrend line. You can see that. And again, it'd be just a little atypical to get that close and not hit it. So wouldn't surprise me to see one more thrust down in copper. And that way you could, if you didn't take this one or if you took it and you took profits on T1, we bought it right there off the lows. Maybe you could recycle back in there. And again, with stops somewhat below, but I wouldn't be adding if it takes out that trend line. Same with those other copper stocks I just showed you. All right, so that was, there was one more. Oops, I'm going to go back. Sorry, missed it. That was right here. Nope, that was the most recent post. We were right here. Okay, I missed, there were more. I saw something about AVD. Yep. Do you still like AVD? Yeah, I think it's one of the better looking setups. These are the agricultural input stocks. I covered these a while back. Majority of those hit either the final target or one of, some of them had 4, 5, 6 targets. They hit T4, T5 and had a corrective wave wherein I think we still get one more thrust up. I'm still thinking the grains are positioned. The RR looks very good over the next year. Again, they can't catch up. They keep hitting these lows, but they're at support. And again, some of them have been moving up. Soybeans, corn is the bottom. Wheat's been just kind of inching along. But remember, as I've showed you in the past, I don't have that chart queued up at a very, 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 very significant long-term support uptrend line, multi-decade trend line. So I think the RR, the risk to reward ratio, is infinitely better on things like grains and all that. So you talk about, making money, that's part of a diversified portfolio. That's more of a, it's both an active trade now, active swing trade, and a long-term trade, those grains. And then the ag input stocks tend to run when the grains start moving up. You have companies like fertilizer companies and the likes in here. And so this is AVD. We put in that divergent low there. This was a big level right there, that $5 target, which was taken out, and the 200-day. You can see right here these blue and red lines. I'm highlighting here. It was support in a bull trend. They were taken out there, the 200s, and this thing started a new bear market. And each and every rally back to the 200s, it was rejected. And then finally just took them both out. Here, let me go to the live chart. That's just a screenshot AVD. You can see it better. Live chart, I can zoom in. So if it can hold above the 200, it's taken out dual resistance. The 200s, both the simple and the exponential, and we're above there now. If it can take out that trend line, even better. And then those are the targets there. So, all right, I think that is it. Let's see if I missed any more. Nope, that's it. Okay. I'm going to kind of jump all over the place. I'm turning on right now on another monitor. I have my alert console, and I've had it set right now to show me the alerts that I've had trigger in the last 7 days. These are all, I believe, each and every one stocks I've covered recently, and I'm going to cover them again. PPC triggered alert. It's not one I jumped on yet because I want to see it solidly. I have an alert set if it breaks 350. So when the alerts go off, you take a look at it. What's the market doing that day? What's the stock doing that day? It's not unusual to get these intraday pierces, and you could see right there, we had one yesterday, only to close the day right back on there, right above it at 43.52. So still a very, very valid and well-defined support level. And this is in the packaged foods sector that's having some issues I read about recently, and those are your targets there. Broad market continues to hold up, so a lot of these short setups are holding up, and that's why you don't want to jump the gun, but I still very, very much like this one. We just need a solid break and or a solid daily close. What does that mean? Well, you can take it intraday. You might not want to take it on a 2-cent drop, especially at the open below 43.50. But as you head into the day, if you're down quite a bit, you're down here, especially if you're looking as we head into the close, if you're down to that level. So what I'll often do is take a starter position, and then when I have the confidence we have a solid close below, or it looks like you're going to get that close below, then you can add to the position. And as I mentioned, this one's also recently taken out, dropped below the 200-day moving averages here, and tried to backtest that 200 simple, got rejected, and it's below them now. So, and of course below the primary uptrend line after breakdown backtests. Also had paychecks. I think I covered all these yesterday. If I'm not mistaken, but paychecks flirting with that 135 support level, and below the 200s as well. And also kind of a tell we're seeing, as the numbers showed today, we are seeing an unmistakable softening in the job market. Even Powell's acknowledged it, and that's the only reason we have a rate cuts virtual lock right now. And again, I've talked on it many times. It would be very unusual to not see that trend continue and build momentum. In other words, more and more job losses. But it's still there's some unique traits, if you will, or quirks in the job market now. I'm just adding a level here. I didn't notice before, a nice gap and some resistance levels there. COVID and the Fed with their excessive easy money policies, too low for too long, has just caused all kinds of distortions. And not to mention the federal government, federal stimulus, free money for everybody, sit at home on your ass, that kind of stuff. That paid, what was it, paycheck payroll protection plan, PPP or whatever. Businesses that were doing, everyone I knew having their best year ever and getting free money crammed down their throat, that kind of stuff. And it's, again, just kind of warped then. And then you have also the government cutting back on jobs in those departments like the BLS and the government agencies that are responsible for trying to do these surveys and get these numbers. So it's been a big guessing game with a lot of imputed data, and then which leads to a lot of revisions because the imputed data gives you kind of numbers that are way off. So that's what's going on in job marketville. But none of it matters, and none of it will until the AI bubble bursts. That's everything right now, and I'm going to show you that again in a second here. So these are just individual setups. Again, just a random eclectic mix of things that have broken down recently. This one, I think, is the final pillar to go in the stock market. We need to see the financials break. They're just walking that line right there, that trend line I gave you the other day, with big divergences building. And when I see divergences that are span, as far as they have here on the daily chart, I move out to the weekly chart, and this paints the big picture to me. Again, there are no guarantees in any of this, but this is what technical analysis is all about. It's what it was built on years ago, many moons before I came along. People that enjoy this stuff and are wired this way to look at charts and realize that you could look and recognize certain patterns that have occurred historically in the past and help predict what the market or a stock or an index is going to do going forward. So this is the financial sector on a weekly view. And, these divergences, they build and build and build. And I talk about them. And about the point right here, it's when you get the people, oh, yeah, divergences, but they don't work. And then they do work. They just take a while to play out. And there are no guarantees. Once in a blue moon, you'll burn through divergences, meaning the indicators just keep moving up and you no longer have that negative divergence. But the arrows I'm showing you, these are all high double-digit drops, all on multi-month, periods. Except COVID. COVID was a kind of a one-offer because of the what I call the Ursa Interruptus, the massive stimulus by all global central banks and global governments, fiscal monetary stimulus. So it was a 6-week bear market. But again, you can see most of these play out. And, based on the technical posture, divergence. There's your trend line. I can't possibly think of any reason. In fact, more so now with the fundamentals. As I told you the other day, the headline came out, the stock market is now the most overvalued in history, which doesn't set the stage for another correction. You could have a correction. We can go to even more overvalued. And remember, there's no limit to overbought, no limit to overvalued. There's no limit to divergences. Those are conditions, not sell signals. They can certainly build, but then history tells us. You go back to the periods of extreme overvaluations, 2007, 2000, and you will see those periods are followed by the biggest bear markets that have occurred in the market. So, all right, that's it. A couple more. I'm just, again, going off the ones that have... when I say, I'm going over the ones that fired alerts, remember, XLF is doing... I need to address that. You have these... If you look closely, and then that skinny part right there on the candle, those are your wicks. Those are intraday breaks. Every single one, even that one there, a little doji print, right back on or right back above the trend line. And so you need to see a solid close below here. And as I like to say, the redder the better. If this was a red candle and we close right here and I have to squint and zoom in, did we break it? You can take it, but you're going to do better if you see a big red close down through there, big red candle. And right now you have also, when you see something like this, a trend line, you have a BOD level right there, benefit of the doubt. I'll put a line there for you, tell you exactly where it is. Why did I do that? 5310, because now you have 1, 2, 3 recent reaction lows there, a reaction high right there. So that's, I think, a magic number as well. I'm going to set an alert. I believe this alert should re-trigger on XLF. TDG, I don't know if I shared this one with you. Back on, as of May 5th, it was the second largest holding in HYG. So as you guys know, I very closely monitor credit spreads, the differential between junk bonds and treasuries. And that's one thing that hasn't been a red flag. In fact, it's been a green flag for the market. Credit spreads have held up extremely well. I'm going to add a level here. I just wanted to... So what I did a while back, back in May, I went through and I listed, I forget how many of the top 5 or 10 holdings in these junk bond ETFs. Because although, remember, in there they hold the bonds of TGG, not the stock. But the stock is going to tell you if there's problems. Little birdies will whisper if there's problems. So basically, if you start seeing the stock finally go down, you can make a reason to short the stock. It's going to tell you there's going to be some distress in the bonds. And then, again, being the second largest holding here, you're going to have you'll start to see junk bond, the credit spreads widen between junk bonds and treasuries. And that will probably be well, it'll certainly be, let's just call it a yellow flag for the stock market in the economy, of course. All right, so that's it. That's a support zone it's coming up on. It danced on the 200s for a couple weeks and broke down. And it's also a short setup, guys. Right now you're coming up on support. This one's been hard to, I don't have a position in it. Again, I'm watching it for the reasons I just stated. But these are the best kind of short trades if you get in early enough. Because what happens, it gaps down there, denies all the longs an objective exit. So those that were holding the stock long had their stops below that trend line. And the short sellers were waiting for a break of that trend line, but it didn't let them in. So you keep short interest low by denying the shorts an objective entry on that big gap down. You also trap the longs in it. So those that didn't do as a stop loss, if they had a stop limit, they're still in the stock underwater, just praying the stock gets back up there so they can exit. But it won't let them because it just had another gap down. And so these are pretty bearish when you start seeing stocks do this. Gap down, consolidate, gap down again. Wouldn't surprise me if it roasted them one more time, going to gap down below this level there. And if it does, keep an eye on the, junk bonds and credit spreads there. And the other ones, I'll revisit. I have a watch list somewhere of all the holdings there. Well, hell, let's just go over it now. Here it is, my junk bond ETF holdings. Again, I did this back in May, so it's somewhat recent. Some of these may have changed, from the holdings. They may have gotten rid of or reduced or increased positions. But that was a bearish engulfing candle and divergent high. Now it's just a divergent high. We made a marginal new high, so I'm going to change that. I haven't updated these charts in a while. Nice, clean little uptrend line. The beautiful setup right here. This is Tenet Healthcare, THC. Fourth largest holding in HYG. I guess I had this one for you as a trade idea back here. T1, 2, 3 hit. We covered all our longs, all our shorts there. Divergent low. Trades very well to the technicals. So what you're looking at, this thing has come full circle, and I am now sharing a short setup with you to be triggered on a break of this trend line. So I'm going to put a price alert right there. Let me just eyeball it. Nope. This is your first support. That's not what I wanted. Come back here, get rid of that. And put a horizontal line right here. You have that previous high right there, the breakout. You have some support, a little bit of minor support there. But I call that the first support level. I wouldn't too shallow for me to target to take gains there. This one I really like. 152.68 is the first target. You have the 200-day moving averages, which it just recently took back here. Remember, it took them out there, dropped below, rejected, stayed below, recovered the 200, successfully back tested. So this is how this one plays out, in my opinion. Comes down here, hits the 200, my 152.68-ish target, most likely get a reaction, and then continue on down to these other ones there. Here, let me go through the rest of these. HCA, divergent. It's another one we shorted back here. 1, 2, 3. We hit all three of my price targets. And this sucker has come full service, full cycle, full circle, excuse me. Almost a divergent high there, slightly higher high, but you have the negative divergence on the PPO up top. Divergence, as I always say, is not a sell signal. What is a sell signal is a break of a trend line. Here we have a very steep trend line, which was recently broken, a little kickback rally right there. CYH, number 6 largest holding. There's a trend line there. If it breaks that, that's bearish. I don't have an opinion on this one. I wouldn't go long or short. It's just chopped around in a sloppy range, but that would be bearish if it broke that uptrend line there. CCO, clear channel. I guess the last time I updated this chart was right here. I had this trend line, it broke, and now it's coming back. Probably push it like this. Been back testing it from low and the 200-day moving averages right now. So if it can recover above it, then that's bullish. Probably going to go up there. If it breaks it, this thing's done much below that, because once you get below $1 for too long, you get faced with a delisting notice, and then that's just kind of a death sentence for this stock. So watch that one as well. CZR, Caesar Entertainment, that's clearly in a bear market and downtrend below its 200s. There's nothing bullish or anything to say about that chart. CCL, Carnival Cruise Lines, active short trade on the site. I still very much like it. Nobody's asked about it in a while. Laid out both the fundamental and technical case. Earnings coming up. That's probably going to be the catalyst. You can see earnings right about, give or take, around the 29th of this month here. So keep that in mind if you're in it. You're going to report. I always say, if a stock's going to report earnings, if I look at the chart and I don't have an opinion on it, it's a crapshoot. You can flip a coin 50-50, or in a bull market, even probably favorable odds, you're going to beat earnings. But if a chart's clearly bearish, whether or not they beat, I don't give two flips about. It's where it goes. That's the market's reactions, all that matters. And based on the technical posture, I think this one goes down after earnings. So still like that. OXY, again, these are all holdings in the junk bond ETF, HYG. And that one recently took out a downtrend line. I'll give it points for that. Tried to take out the 200s. It's been under the 200s, but right now it's still testing. It's right on the 200 exponential, that red line. So I don't have much of an opinion. Just can tell you if it does that, then that's bullish. If it fails that level, especially if it moves down below this uptrend line, that's going to be bearish. TDG, I think, yep, I already covered that. F, Ford, yep, junk bonds, meaning it's below investment grade, or wouldn't be in that, wouldn't be a holding there, unless anything's changed since I updated these, put this list together back in May. T-Mobile, put in a divergent high there. So far, that's the high. I'm going to take this yellow trend line, tighten it up a little bit right there. This is your primary uptrend line right there. So make that a little fatter so it stands out. Set a price alert. And that will, nope, that's not what I tried to do. Tried to do this. Create set alert. And yeah, if T-Mobile breaks down, that will be an objective short entry. BHC, Bosch Health. It's big, sloppy. You know, this is a stock just struggling, long since peaked, like a lot of these. And remember, this is at a stock market at or near all-time highs. If a company stock is underperforming in this market and we haven't yet entered a recession, this is where what happens is these junk bond stocks that have questionable fundamentals, that's why their credit rating is low, they just go away. You start seeing default rates spike. The stocks are going to go down. This one, until it breaks above or below the trading range, it's just, that's it. It's in a trading range. If you want to know where I think it goes, well, we put in the most recent divergent high there. Look what happened the last two times we put in divergent highs. It went down. Oops, that's not what I meant to do. Divergent low, you rally. Divergent high, drop. Divergent low, or almost divergent low, rally. All right, AAL, American Airlines, uptrend line, divergence building. So this rally's probably nearing the end. Here's a stock, again, clearly in a bear trend. Bear trend is defined as a stock making lower lows and lower highs, and that's exactly what we have here. So, right? Okie doke. One more, CNC. Here's a good example of playing around in this field of crap stocks, you know, stocks with questionable fundamentals. This one had, you know, nice reaction low there. And so if you were long this one, and I've talked about this recently and many times in the past about trying to mitigate risk on individual stocks, especially when they report. That actually was between earnings. So there was earnings there. That wasn't even an earnings event. There must have been some news headline. So so let's say you're in this stock and you say, okay, you know what? I'm going to put a stop a little bit below that previous low right there, $53. I'll have it somewhere there. And you had a stop loss order. Well, guess what? The stock opened down here. Your stop loss order would have been got in line with everyone else's that morning when it got with the order imbalances and filled somewhere down around where it opened. It opened that day at around 33.90. So about $33, $34 would have just blown you out of the water as far as losses go. Now you could have done a stop limit, says sell me at 52, but only 52 or better. Well, guess what? Your order's triggered but not filled. It's still open. And the only way that you close that position out is if it gets back to that price. Otherwise, if it gets going lower, you keep losing money. So it's a great example of, the risks on some of these stocks. And you're not going to have a gap like that. What was that gap? 38% gap. Blue chip companies, and that's what the longs I've been sharing, or at least the majority of those lately on the stock world, are those beat down quality names, with more solid fundamentals, maybe a little questionable. They've been beat down, but blue chip names. All right, that's that list. Let's visit gold, since gold broke out. A lot of chatter on gold lately. I'm going to remove this divergent high in the island cluster top because it doesn't matter much anymore. It did matter. It put a top in gold for God, what was that? That was back in April. And so that yellow box, you can see it's a very well-defined trading range, and we just broke above it. As I said, any breakout above it would be, and is now, a divergent high, negative divergence with overbought conditions. And as I often say, negative divergence is not a sell signal, but breakouts that occur with divergence have a much higher failure rate. So we'll look at the 60-minute chart. I don't have it really marked up. There's the breakout, divergent high, divergent high, divergent high. So we had that triple or almost quadruple top there. Broke out above it, getting a little stretch now. And remember, the dollar, this is what leads me to believe until unless this change, until unless the dollar takes out that key 26.90-ish long-term support level right here, my preferred scenario is the dollar's in an uptrend, put in a major bottom there, broke out of that bullish falling wedge, hit my first target there, had a correction, goes up here. What would cause that? One of the things that, everybody, the rate cuts baked in the cake. Some are even clamoring for a 50 basis point cut. If we get some hot inflation numbers or whatever reason, maybe Powell wants to assert his dominance, and independence and surprise and not cow down. And I don't know if he can override the rest of the group or would, but or natural market forces. So just watch that. If this happens, that will be, again, a net headwind for gold. And then silver is going to follow gold ultimately. So gold just broke out the new highs, so silver did as well. But the divergence in silver, this is what you're looking at here, gets bigger and bigger. And so, as I've said recently, GDX, the gold mining stocks, got away from gold. I've got to. I need to pull the ratios. I had a mental note to do that. I need to pull the gold GDX ratio. Imagine it's pretty crazy right now. But so we've had this huge run up lately. The miners anticipated. They had a trading range too. They anticipated, but broke out long before gold did. So God forbid that breakout and gold fails. There's a tremendous amount of hot water here. And one of the things in GDX is you watch crude oil. They like low energy prices because that's the second largest input cost to them behind labor, just like the airline stocks. Labor is number one, fuel and energy is number two, to get all that gold and all the metal out of the ground, gold and silver. I think the run up in the miners might have been, I didn't read much on it. The Trump administration's promoting, more production and less reliance on the rare earth metals. And so maybe there's been just a broad blanket bid. You have to really know your miners, which ones might be a beneficiary, within, if any, in the GDX. And I'm sure there's some, but either way, this is crude, persistent, persistently high prices. We've had a few corrections, but we're back into my yellow zone. These are zones I gave you last year. The way it works is the higher you get up there, the bigger the impact it has on the stock market. And again, the miners as well. If crude oil was down here, that would be, again, more supportive for the rally in the mining stocks. So, but ultimately gold, they're going to follow gold. That's the most important thing. And so right now I don't have a near-term opinion on where it goes. I'm just watching it for any anything in the charts. I just don't see a whole lot other than the recent breakout. But again, I think the upside in the breakout's limited for the reasons I said. So can't make a strong case to short it because the breakout hasn't failed. But wouldn't chase it here. Just based on the technicals. Okay, this video went long enough, so I'm not going to cover the Mag 7, Mag 8. I'll just show you real quick the differential or the difference between QQQ. You can see here, and both QQQ and SPY and their equal weighted indexes. So this is QQQ, my daily chart. You can see here, I still maintain this first target zone down here on the daily chart. These are longer term targets. Those are, you know, independent, if you will, of this official trade here on the 60-minute chart. I already covered that in the beginning. So when you look at QQQ, I'll go back to the daily chart, and then look at QQQE, the equal weighted, and it shows you the difference here. These equal weighted stocks have been moving the equal weighted index, when you don't apply that bigger weighting, you can see, and this is just a way to quickly view market internals, market breadth, by looking at the regular indexes, the market cap weighted S&P 500 and NASDAQ 100 versus their equal weighted counterparts. And you can see this is a level I've added here. We had a major reaction high there. They broke out to all new all-time highs, and as anticipated and expected back at the time, that breakout failed. We had other reasons to go short. We had a trend line break on the 60-minute chart. This is my daily, but that breakout, as expected, failed, and that was followed by one of the biggest corrections in many months or years, 23% drop. And then you had, again, a marginal right here breakout, a new high breakout, which has also failed. We fell back below that previous level, and we're below it now. But this is a level I think that'll do the trick on the equal weighted, 96.50-ish right there. It's where we've been bouncing on. Again, you can box in like that. We have that trading range. And again, you can see the weakness there between that and the regular cap weighted QQQ. And then you can do the same thing with SPY. Looking at the S&P 500, who's on a sell signal recently, as I highlighted, broke down below the uptrend line. And we're still below it, but we're within spitting distance of all-time highs right now. And then you plug in RSP, and you can see RSP is noticeably lower below, and also clearly below its nice clean right here uptrend line. Lots of clean reactions off the April lows, more recent reactions there. Big divergence, just a big old fat bearish rising wedge pattern, ripe for the breaking. Remember, we last time or earlier in the year when we covered here, we rode that short down on the market, shorted back on up to the 200s, but not above the 200s. And then, as I said, from this point right here, we started building divergence. So we didn't have divergence there. Now we have big negative divergence, just like we had heading into the beginning or late 2024, early 2025 in the markets. And so, and then you have a breakdown as well on the equal weighted right here. So we just kind of got to get going here. And that takes you back down to the 60-minute charts I showed you, some near-term levels that need to get taken out on QQQ. RSP, most of you don't trade the equal weighted. I don't. If you do, let me know and I'll give you more charts on this. But that's a near-term support level right there, 185.44. That needs to go on RSP. Okay, I'll just wrap it up here, reminding you that we have the economic report tomorrow is the ADP non-farm payroll. This is a big one. You can see here, we click on it. Guys, I'm sorry. I mean, the ADP was today, of course. We click on that. This is it. Non-farm payrolls right here. This is the one you want to watch tomorrow. You can see they're expecting a number of 75,000. We'll see where that comes from. There's our forecast. The previous number was 73. And again, you can click this link if you want to see how things have been trending. And it's pretty clear. Toggle over to this. Oh, you can look at it this way. So it's not much. It's been a slow roll, but you can see overall, it's going to draw the arrow down. If you were to just put a smoothing or moving average in there, you can clearly see where the trend is going. And not a lot of room to start flipping negative. So watch that one tomorrow. Again, it's about the market's reaction, not what the actual number is. And you guys have the levels to watch. Let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.